Well, welcome everyone to FMD's post-budget briefing. This morning I'm joined by Richard Dahl, Chair of our Investment Committee, Jeremy McPhail, Head of Investments for FMD, and Cam Sicker. Cam's one of our financial advisors in the Melbourne office, and Cam's joining us especially to focus today on the financial planning implications of tonight's budget, or last night's budget, should I say. Cam, we'll start with you. Can you just start to cover off maybe the 4 or 5 key financial planning impacts that came from the budget? And I guess many of them were telegraphed already, weren't they?
Yeah, a lot of it was pre-announced, but one of the key ones that everyone's talking about is the amended Stage 3 tax cuts that have already sort of been legislated and are due to come in from 1 July. So it's touted as a tax cut for all taxpayers. So basically, if you're paying any tax, you'll pay less tax next year. What that might mean for financial planning impacts is if you've got some capital gains or something that you're going to realise, if it's selling some shares or selling investment property, it may be better to do that next financial year when you've got lower tax rates. It's not going to be a big impact, but it's an impact nonetheless. So if you're earning 100 grand, your tax is going to be about $2,179 lower next year, and if you're earning close to 200, it's sort of $4.5 grand. So it's not insignificant, but if you can delay these things and wait till next year, you might as well and pay less tax. Another big one was it's all cost of living based. This year it's all about cost of living. So energy bill relief is another one. So every household is due to get a $300 rebate on their energy bills. You don't have to apply for it or anything. It is automatically applied in quarterly instalments. It's not means tested, so everyone gets it. Interestingly, if you've got a holiday home, your holiday home gets it as well. So it is every house in Australia. So if you're in Victoria paying a bit more land tax, you'll pay a little bit less electricity next year.
Well, there's something, Cam.
Yeah, that's right. Another good one was the HEX changes. So we talked a little bit about HEX in another video recently, but the indexation is associated with it was previously linked to inflation, basically, and now it's linked to the lower of inflation and the wage price index. And that is going to be backdated to the last indexation that happened. So last year it was 7.1% as inflation, but the wage price index was 3.2, right? So you've got that extra benefit there. So if you've got an average debt of $26,000, it's about $1,200 that you'll have automatically rebated back to your loan, sort of thing. So another benefit for those with HEX debts. The other things are just small maintaining pieces or adjustments. So super contributions are due to go up to 11.5% next year for the employer contributions. That's now applies to government paid parental leave schemes, so that will apply to that as well. They're due to implement super contributions with every pay packet you get rather than in quarterly instalments or however often your employer makes them. So if you get paid monthly, you'll see a monthly payment into your super fund, or if you paid fortnightly or weekly, you'll see a weekly or fortnightly payment into your super fund. Deeming rates are on hold for older Australians, so those that are paying age pension, all those sorts of things, they've been frozen again at the lower index, at the lower deeming rates.
What's the consequence of that, Cam?
Yeah, so if what's happened in the last 18 months is interest rates have gone up and they froze them at very low rates. If they decided to stop freezing them and increase them up, you'd have some people potentially receiving less age pension payments. So that's very politically fraught with danger. So they've decided to keep it frozen again, so that
and
again,
cost of living too, yeah?
It's a cost of living. It's a cost of living to maintain people's income and not cut their income. So that's the main thing. Same thing with PBS, right? PBS medicines have been frozen as well.
Yeah, great. And what about for small businesses? Anything new in there for small business owners?
Only a couple small things. Again, the instant asset write-off has been extended again. I believe that was supposed to be legislated. That hasn't been legislated yet, so they've just extended that for another year. So a $20,000 asset can be instantly wrote off for small businesses, and the energy bill relief applies to some small businesses as well. It says some eligible small businesses. I don't know exactly what eligible means, but I think
it's quite small businesses, Cam, and it's $325. So you get an extra $25, but I think the business has to be quite small.
Correct. Yeah, correct.
Yeah. And finally, aged care. What's in the budget around aged care?
Yeah, so again, pre-announced, not any major changes, just more funding. So they're funding more home care places and things like that. So they're trying to encourage more people to get help at home rather than going into these aged care facilities, which are under a lot of pressure at the moment. So nothing big there, just continued support for home care packages.
Great. Thanks, Cam. Thanks for joining us this morning. So, Richard, Jeremy, if we have a bit of a look at the budget, clearly last night the Treasurer was trying to thread the needle between cost of living relief and inflation and try and keep inflation under control. For a start, how do you think he's gone with that? Maybe, Jeremy, I'll start with you.
It's a challenge, and we know it's a challenge with such a strong labour market that could be inflationary for the economy. So yes, cost of living relief has been put in, and generally that's going to be inflationary. Tax cuts are likely to be potentially inflationary as well. So while they're only small measures, it's trying to get the consumer confidence back up, which, if you look at the forecasts from a GDP growth perspective, we're in the worst period at the moment, and that's expected to recover and improve from here. Now, that doesn't really give you really good signs of where inflation's headed, though. I would have thought inflation, with the measures that have been put in and the spending measures that have come out of the budget, is likely to be more inflationary on the periphery than anything.
So, Richard, the worry with inflation for most Australians is interest rates. What do you think the likelihood of an interest rate rise is now?
Well, I think prior to the budget, the Reserve Bank governor was talking about potential an interest rate rise, where the market has been pricing in some rate cuts optimistically towards the end of the year. The consensus sort of view at the moment, looking at last night's budget, is that the measures, while they are in the short term maybe slightly inflationary, they might put pressure on down the track, but it's more than likely that rates may stay where they're at for the year. But it remains to be seen whether rates in 2025, 26, if there's upward pressure based on the projected forecast expenditure and the revenues coming in.
Mm-hmm. So it's a bit of a wait and see.
Yeah.
Yeah.
I think though I mean, it's a wait and see, but a lot of our clients have benefited from higher interest rates and in cash and deposits. So they can have confidence that it looks as though those rates will stick around for a while, Lee.
Yeah, good. Obviously, one of the things we look at or think about when we think about interest rates, Jeremy, is currency.
Yeah.
Do you think this budget will have an impact on the Australian currency, and if so, what might that be, and how will it flow through to the investment world?
Yeah, and if the inflation expectations come through as the government's projecting, you would expect that the RBA will have capacity to reduce rates. That's not a good thing for the currency, because it puts a greater difference between our interest rates and interest rates that you can get overseas. And so if you're an offshore investor, you'd be thinking about, well, I can get a better rate of return from a different economy or a different country, so I'm going to put money into that country, and therefore there's less demand for our currency, so it puts pressure onto that. So that's a concern that the government and the RBA will have to toil with as they consider policy in future.
Yeah, and so if we're not sure which way currency goes, and it's very, very hard to predict, and it's probably more dependent on other countries' central banks than ours. Is that right?
Yeah, I'd agree with that. Yeah. So, and I mean, the US being the major economy and major financial centre that it is, a lot is based on what happens in the economy there. So still most markets will be watching inflation, jobs markets in the US to see what signs they have. And they've got an election later in the year. So it's unlikely that they're going to be spending cuts coming through from their governments over the next 6 to 12 months. So you would think that would still see interest rates relatively high over there.
Great. All right. So, Richard, let's think specifically about FMD portfolios for a moment. Are there any specific investment considerations coming out of last night's budget?
I think, well, it's always good to have a look and say, what impact is this going to have on the major asset classes and we've talked about cash and deposit rates, which will remain high. And so short-term fixed interest rates remain high, which is good. Good for our clients, but let's have a look at bonds and shares. With long-term bond rates, they've lifted more recently with the inflation outlook as it is. It looks as though that this budget is not going to make a big difference with bond rates. So the portfolios have a reasonable exposure to Australian government bonds, and they provide good yields. Now, those bond rates have been moving around up and down a bit as markets try to predict what's going to happen with interest rates. I think there'll be a bit of stability in those bond yields, and therefore not a lot happening in fixed income. Therefore, the portfolio settings are appropriate as they stand. In shares, equities, if we have a look at what happens there, Cam has alluded to some of the things coming through with tax cuts and the general measures around the place helping the consumer. So the consumer discretionary has been under pressure. It might be lifted a little bit. Building coming forward, we were talking about that earlier with what happens to building stocks might be lifted. But overall, I think the impact on the Australian share market will not be totally significant, because what's really driving that is what's happening in the US to a large extent. But the positions in the AMS portfolios still remain sort of in a position for improving growth. So I think overall we could probably say the budget measures are broadly neutral.
Thanks, Richard. Jeremy, is there anything for the Australian economy at the moment in the Future Made in Australia program that the government obviously announced and is planning to fund?
Yeah, definitely will be. Whether that's positive for listed companies will be of interest. Some of these technologies and some of these avenues for renewables, which is largely what the spend is for the future energy supply for the country. A lot of those are private businesses and private opportunities. So as an investor in ASX securities, there will be some benefit, but it's hard to see direct implications for any one business or any sort of cohort of businesses in Australia. But yeah, and I suppose some of that is still inflationary though. So it's more spending, it's onshoring. Cost of labour here is higher than what it is offshore. So some of those things are something to keep in mind as well. That may still prolong the higher interest rates for a period of time. Good for investors if you're allocating to that asset class, but still means if you've got a mortgage or debt, it's going to cost you more in the foreseeable future.
So a bit of a wait and see on that one as well, I think.
Yeah, this is a long change. Yeah, this is a 15 to 20 year change that we're going through at the moment as we move away from fossil fuels and dirty energy to clean energy. And it's not something that you can flick the switch literally to turn one source off and turn another on. So it's a long process to change. And clearly the government's starting to commit some capital to this. So that's a positive sign that we're heading in the right direction. It's hard to see currently the specific investment opportunities though for investors.
Thanks, Jeremy. All right, well, we might leave it there. Thanks very much, Cam, for joining us this morning to give us an update on the financial planning implications. If anything Cam's raised this morning piques your interest, please make sure you talk to your advisor. Richard, Jeremy, thank you very much again for joining me for an economic update post-budget, and I look forward to catching up again next quarter. Thank you all.
Thanks, Lee.
Thanks, Lee.
Thank you.